You're listening to Friends and Family Capital's First Principles Finance. Our goal is simple: keep you building. Each episode, we discuss tactical questions from our network. I'm Colin Anderson, founding partner of Friends and Family Capital and the former CFO of Palantir Technologies. After years in the trenches, we'll explore the scar tissue, frameworks, and insights that help entrepreneurs turn finance into a force multiplier. Let's jump in. All right, founder questions for this week around pricing. Very exciting topic. You could talk for hours. We're going to try to boil it down to just a few minutes here. Flavors of the question that have come in. Hey, I'm working on selling software to a company doing a big rollout nationwide. How should I think about pricing it? Another version of it, although very similar answer you'll see. I'm working with manufacturing facilities, industrial facilities, helping them avoid downtime, helping them understand their operations. How should I think about pricing that? Very different industries, but at a certain level, very same answer when it comes to pricing. And in both those cases, the answer is not, let's talk about pricing. The answer is, let's talk about value. That would be the first principle reframe here. Excited to jump into that today. So why talk about value in the first place? Why do you even need to reframe this? Well, a couple things. Pricing inside of an organization often gets to be a very messy conversation. Everyone has an opinion. Everyone's trying to work on this. It can take a lot of churning. There's a lot of fancy consultants out there that will sell you their time and their materials to help you come up with the exact right answer. The only problem is there is no exact right answer. A lot of it's trial and error. Each customer is sometimes different. So helping to understand the value that you provide a customer, actually for me, was helpful because it helps to understand the ceiling. Now there's answers all up and down there, but once you understand the first principle ceiling based on the physics of how your customers use your product, how your customers value your product, then at least you have a North Star to help you get your bearings and power through those somewhat messy conversations where there is no right or wrong answer, just a bunch of decent answers. North Star, value, how do you even understand that? Well, first, you need proximity to your customer. If you're not close to your customer, if you don't know your customer, you don't know their business, you don't know the outcomes they try to enable for their customers, then you're lost at sea. You don't have that North Star. So first and foremost, really get to know your customer, learn how they want to use your product, and learn what value it creates for their customers. And then you'll have a pretty good understanding of what your maximum ceiling on pricing could be. Second phase, what feels fair? Once you know that maximum ceiling, where do you set the landing? Where do you decide to price it? Well, for here, I'd say make sure it feels fair to your customer. That's how you create velocity in your sales process. What does fair mean though? That's open to interpretation. Generally, I think it should feel very much favorable to your customer. What does that mean? Well, I've seen it work very well. Well, the customer gets 90% of the upside and you take 10%. That's probably what feels fair. You can do 80-20, but 50-50, even though that seems fair in the real world, or you're dividing a slice of cake and you want to share it, great. But in this case, it should definitely feel disproportionately favorable to your customer. With that in mind, let's dive into some real world examples. First, let's look at that software company that helps enable a nationwide rollout for a brick and mortar chain. Let's just say it's a retail chain. Well, if you're close to your customer, you'll actually understand their business. So let's put some numbers behind this, just assuming that we've spent the time to have that proximity. Let's say you're helping them roll out stores across the country and they can do 10 stores per year. With you, they can do 20 stores per year. And each of those stores, once they're up and running, can actually give that customer $10 million of free cash flow. Awesome. So that means there's $100 million of free cash flow, 10 times 10 in the first year. And there's $100 million, 10 times 10 of free cash flow in the second year. What if you can bring velocity to their rollout process? What if you can make the impossible now possible? What if you can bring 2 years of rollout into 1 year of rollout? Well, you're not just selling seat licenses at that point. You're actually talking about shifting $100 million of free cash flow, real cash, into the current period. I'd say that's a $100 million problem. But that's the level of impact you can have for the company on just their free cash flow. But there's actually an even higher level you could go. What is that company's valuation determined on? And on free cash flow, I'm just do a simple number to keep it easy. Let's say they're valued at 10 times free cash flow. If you can shift $100 million from 1 year into the next, that creates $100 million of free cash flow, but $1 billion of value on their market cap. So we're talking real numbers here. So when you think, okay, how should I think about pricing this? It's not how many humans are using your product necessarily. If you're providing unique value that only you can do, and you can make that sort of business outcome a reality, that's really your North Star. That said, you're not taking all of that money. You should leave 80, 90% of it in the customer's hands. In some cases, even more, but at least you know what you're working with and you know how to price it because you know where the value is. Let's look at the second example. Manufacturing, industrial, sounds very different than retail rollout. But at a certain level, you know that each of these plants, each of these factories makes a certain amount of money for its parent customer per year. Again, keeping the math simple, let's say they make $10 million per day that this plant is operational. Great. So what does that mean? Every day it's not operational, it costs them $10 million a day. Pretty simple. If your software can minimize the downtime, let's say typically they're down for 20 days a year, you can bring that down to 10 days a year. Again, 10 days times $10 million, you've saved them $100 million. You put that 10x multiple on it on free cash flow, you're talking $1 billion problem again. So again, you're not exactly going to have this conversation in the room with your customer, but you should really understand what's the value of it and then make sure that they win a lot, and you capture a little bit of that value along the way. So now we've got two practical examples. Let's talk through some other considerations as you're thinking about value and you're thinking about that pricing. First and foremost, the higher up in an organization you're targeting, the easier it is to have that conversation around value. If you're selling to the CEO, they're probably thinking about the stock price. That means they're doing that 10x multiple on the outcomes that you enable. The further down in an organization you go, they're still very focused on value. They're focused on their outcomes, but they have fewer degrees of freedom and maybe less of the total picture of the organization and how what you do really shapes that. Now, it's not always true. Sometimes they understand it the most, but also they may not be able to pitch it at the highest levels to that. So really judge not only what the value is you provide, but which aperture are you selling into and what degrees of freedom does that person have within their business. So that's a really important one. Second really important one, and this is just experience from the trenches. I've seen pricing conversations actually be very unproductive for organizations. Pricing is very sexy. The pricing conversation is very attractive inside of an organization. Finance people try to jump on it. Sales people try to jump on it. Executives try to jump on it. And there's no right or wrong answer. So I've seen bad cases where this actually just spins out of control because everyone has their reasons why they think their idea is the best. Generally, what I found is understand your North Star and then get to work. Just start trying things. A simple, stupid version that maybe it's tongue in cheek, but I think it's been interesting is just double the price in every conversation and wait until you get laughed out of the room. And then you know you found your ceiling. And that probably is going to come somewhere around 10% of the overall value that you can propose to a customer, assuming these frameworks work. The other consideration, think about how you fulfill that value. Obviously, you can't be an unprofitable business and remain independent forever. Just the math doesn't work that way. So think through value at the top, price in the middle, and then your cost to provide that value underneath that. And the margin of your business that ultimately one day investors will judge you on is how much were you able to price it for relative to how much did it cost you to fulfill that. So now you see sort of the ladders and you'll play around with those. Those will change over time. You'll have better input data. You'll have scale advantages. You'll have less waste the more you know what works and what doesn't work. So everything doesn't have to work at the beginning. It can come in line, but it's helpful just as a North Star to understand those are the three moving pieces that you should be able to understand and monitor as you scale your business. Another consideration when it comes to talking about pricing or with the reframe value inside of an organization, there's no right or wrong answer. There's just empirically what works. That can be a problem if you spend too much time in the conference room, too much time in the boardroom discussing it because everyone has ideas. Everyone wants to fight for their ideas and you can go around and around in circles. I've seen countless times where people spend a lot of time figuring out what the optimal pricing rollout should be and they don't iterate. They discuss it. And a lot of the other things they should have been doing to build strength on their financial org or their business at large go neglected. So I'd say take the right amount of time, have a real discussion, but don't let perfect get in the way of good. Just get out there and see what the market will bear and keep track of all the blocking and tackling that you need to keep scaling your business. Another consideration, let's just think of pricing and value in the grand scheme of things. Value, that's the highest that you could ever charge. You're probably going to take some portion of that for yourself. That's going to be your price. But also, what does it cost for you to fulfill the value that you give your customers? That's your cost structure. Over time, you have to make sure that price is well above what it costs you to fulfill it. That's going to be your gross margin. Then you've got to cover everyone else below that. That's how you get to your free cash flow. Now, everything doesn't have to work out at the beginning. I just say start tracking these things and have a view as you scale. Where do you get scale advantages? Where do you get cost advantages? Where do you get more efficient? Where do you stop wasting time or energy or capital? And make sure that you think you have pretty high conviction that when you get to that end state, that all the math will work out and that you can remain an independent business. Again, the North Star there, value, but all these other things really matter and they're part of that conversation. A final very important consideration when it comes to thinking about value and delivery and the cost of that delivery is think about your relationship with your customer over time. It's not about just the value today. It's how much value do you think you can provide to that customer over a long period of time if you're really building a partnership. Now, what does that look like? No one gives you their biggest problem to start. No one gives you their hardest problem to start, but you earn the right to get access to those hardest problems over time. So take your model of the customer, take a view on all the value you could provide over time, and that'll help you calibrate how much risk you're willing to take, whether it's your time or your dollars, in order to explore in the early days the value you can provide and the price you capture there. So take the time to understand where you are at the beginning and the value you provide, the price you charge for it, and the cost it takes you to provide that value. And also project that forward. Fast forward 2 years, 5 years, 10 years. What do you think that relationship could grow into? How much value do you think you could provide to your customer? What do you think you'll be able to provide that for? And that'll help you inform how much risk you want to take, whether it's time, attention, capital, or the opportunity cost of not working with other partners. So really think about the totality of value, not just a point in time of value. So in conclusion, you're going to hear the word pricing. You're going to have these discussions a lot as you build your business. The key thing as you approach those conversations, really think about the North Star, and that's value, that's customer value over time. How do you uniquely solve problems for your customers? How do you give that value to the customer? And how do you ensure that you capture some of that value, whether it's value-based pricing, seat licenses, paid for outcomes, consumption-based pricing? You'll find the right answer there. Just make sure it always feels fair to the customer, and that means they're probably going to win disproportionately to you. And that's okay. Let's get back to building. Thanks for listening to Friends and Family Capital's First Principles Finance. If you enjoyed today's episode, please leave a rating on Apple or Spotify. It helps our founders and finance leaders find the show, and it helps us course correct as we build. We appreciate you listening. See you next time.
A note from our friends in legal. The views expressed here are those of the individual Friends and Family Capital Management, F&FC, personnel quoted, and are not necessarily the views of F&FC or its affiliates. All opinions expressed herein by F&FC personnel or guests are solely their own opinions and may not reflect the opinion of F&FC. Opinions are subject to change without notice. This content is for information purposes only and should not be relied upon as a basis for investment decisions.